Good morning, everyone, and welcome to today's session on Introduction to Financial Accounting. My name is Salma Siddique, and I'll be taking you through the fundamental concept that lay the foundation for understanding how business track and report their financial activities. So, let's give you a lecture overview. We'll begin by understanding what financial accounting is and its objective. We'll then discuss who uses this information, why it's important. We'll dive into key terms like asset, liabilities, and revenue. We'll look at the accounting cycle, the double entry system, and financial statement. We'll wrap up with a quick activity and a recap. So let's begin. So, what is this financial accounting? Financial accounting is a structured way of recording, summarizing, and reporting a company's financial activities. It used to prepare financial statements that show how a business is performing. The focus here is on past transaction, what already happened, so business can report accurately and comply with laws or investors' expectations. Now, the objectives of financial accounting. There are four main objectives: recording transactions properly to avoid errors or fraud, determining profit or loss, did we earn or lose money, showing financial position like what the business owns and owes, providing information to help others make smart decisions like investors deciding to invest or managers deciding where to cut costs. So, what are these characteristics of financial accounting? Let's look at some key characteristics. It's historical, based on actual past event. Follows accounting standards, so everyone's reports are consistent. It records only quantitative money related data, and it's objective, meaning every transaction should have proof like receipt or invoice. There are two main categories of users for the financial information. One is the internal user, second is the external user. Internal users like managers and employees uses this information to run operations and set goals. External users include investors, banks, government bodies, and even the public. They use report to evaluate a company's health, trustworthiness, and compliance. Financial accounting helps in many ways. Decision making: should we expend or cut costs? Legal compliance: are we paying the right taxes? Investor trust: are we being transparent? Planning: what can we afford next year? In short, it helps business stay accountable and grow responsibly. The key accounting terminologies. Here are the 5 foundation accounting terminologies. Assets, something you own. Liability, something you owe. Equity, your ownership in the business. Revenue, money you make. Expense, money you spend. Let's now explore each one in more detail with examples. Assets. They are the resource that brings value to the business. This includes cash, inventory, building, vehicle, and even trademarks. In a bakery, think about flour, oven. So assets can be short term or long term. Short terms are which are called current asset, and long terms is non-current asset. Now the question, for example, for assets could be, what assets might a bakery have? So as I said, current assets, which are short term, they could have cash on hand or in the bank. For account receivable, their money owed by customers if they buy on credit. Inventory, ingredients such as flour, sugar, eggs, packaging materials, and finished baked goods. Prepaid expenses, rent, insurance, or utilities paid in advance. In terms of non-current asset, which is long-term and used over time, number 1 could be baking equipment such as oven, mixers, refrigerators, dough sheeters. Number 2, furniture and fixture, display shelves, counters, tables, chairs. Vehicles, delivery vans or trucks. Leasehold improvement, renovations made to rented premises. Number 5, property, if the bakery owns the building or land. Number 6, intangible asset, trademarks, brand name, or proprietary receipts. So now let's move on to liabilities. Liabilities are debts or obligations. Now the examples could include loans from bank, unpaid bills to suppliers, rent or wages that are due. Think of your own life, student loans, phone bills, credit card debts. These are all liabilities. Liabilities are also short term and long term. If you owe to someone for more than a year, it's called non-current liabilities. If you owe within a year, it's current liabilities. So ask yourself, what type of liabilities do students typically have? As I said, it could be student loans and many others that you might think. So now move on to equity. Equity is the owner's interest after subtracting liabilities from asset. It is the owner interest in the business. If a bakery has assets worth $10,000 and owes $4,000, the owner's equity is $6,000. It's what left after paying debt. It also includes any money the owner invested into the business. I'm basically talking about the equation here, which is equity equals to asset minus liability. So the asset is worth $10,000 and the loan, which is liabilities, is $4,000. You do $10,000 minus $4,000, you have an equity of $6,000. Or another example could be investing in a lemon stand business. Now the revenue. It is the money earned from business operations like selling cakes, providing a service, or earning interest. For example, a bakery earns revenue by selling pastries. A tutor earns revenue from teaching business or teaching sessions. This is often referred to as the top line of the income statement. Examples also could include sales, service incomes. Now moving on to expenses. These are the costs you incur to run the business. There are many things which could include, such as rent, salaries, raw materials, electricity, or advertising. Without controlling expenses, even a business with strong revenue can lose money. So there are two types of cost. First is fixed cost, the other is variable cost. So let's start with fixed cost first. These are the costs that do not change with the level of production or sales. They remain constant regardless of production. The examples could include monthly rent, salary for permanent staff, equipment depreciation. Even if you sell 0 cakes, one day you still pay rent. Now the variable costs. These are the costs that change directly with the level of production. They fluctuate based on output. In a bakery, ingredients like flour and sugar, hourly staff wages, utility bills that rise with oven usage. The more you bake, the more you spend. So these vary with production. And I've given more examples here. Please have a look at this slide as well. So as I have explained all the key accounting terminologies, now I've given few examples and look at these 5 items and see whether they fall into the category of asset, liability, equity, revenue, or expense. Let's take a minute and think about it. So have you thought about it? So let me give you the answer. First, the office furniture, which is an asset. Rent paid is an expense. Loan received is a liability. Sales income is a revenue. Owner investment is an equity. So the accounting cycle overview. The accounting cycle overview outlines how financial data is handled. It identifies the transaction, records in journal, posts to ledger, adjusts for accuracy, prepare financial statement, This process ensures nothing is missed and everything is documented. Now let's look at the crucial thing, which is the double entry system. Every transaction affects two accounts. One is debited, the other is credited. For example, buying a chair for $500 using cash. Debit furniture, credit cash. The system keeps the accounting equation in balance. Now, you have looked at the accounting equation in equity segment. You might ask, what is this accounting equation? Well, this is the most fundamental and the basic accounting equation which you will need in your entire life, which is asset equals to liabilities plus equity. This is the foundation of double entry system. This is what you need for your entire accounting. So let's give you an example. Let's say you buy a van for $5,000 with a $2,000 loan. Assets go up, van. Liabilities go up, loan. Equity stays the same. The equation balances. Now let's go for the principle of accounting. These principles guide ethical and accurate reporting. Consistency uses the same method over time. Prudence, don't exaggerate profit. Going concern assumes the business will continue. Accrual records when events happen, not when cash moves. Match expenses to related revenue earned. Now let's have the look at the accounting concepts. These concepts shape how data is interpreted. Business entity. Business is treated separate from its owner. Money measurement. Only record measurable items, that is measured with money. Dual aspect. Every transaction has two effects. Periodicity. Reports cover defined period. Historical cost. Record original purchase price, not market value. Now the role of GAAP and IFRS. Well, these are the standards they follow to create a financial reporting. GAAP is basically general accepted accounting principle, and IFRS is international financial reporting standard, which are rules that ensure consistency across business globally. They make report comparable, transparent, and trustworthy for investors. Now, the book of original entry. These are the journals where transactions are just recorded. Sales journal for sales, purchase journal for purchases, cash book for receipts and payments. These entries are later posted to the ledger. Ledger account. Ledger organizes transactions by account type. Examples: a cash ledger tracks all cash movement. A sales ledger tracks all revenue. Ledgers help create a trial balance. Trial balance is a list of all account balances. It checks that total debit equals total credit. If the book don't balance, there is likely a mistake. Adjusting entries. Adjustments are made at the end of the period to reflect reality, accrued income or expenses, prepaid rent or insurance, depreciation of equipment. These ensure accurate, up-to-date reporting. Financial statement introduction. The main financial statements are income statement, balance sheet, cash flow statement. Income statement. Are we profitable? Balance sheet. What do we own versus what do we owe? How is our cash flow statement? How is our cash moving? Together, they tell the full financial story. Income statement. This report calculates revenue minus expenses equals to net profit or net loss. It shows how well the business performed over a time period. Investors and managers rely heavily on this. Statement of financial position, also called the balance sheet. This shows what the business owns asset, what it owes liabilities, and what It's left for the owner equity. It's like a snapshot of the company's financial health. Cash flow statement. This shows actual movement of cash. It is divided into operating activities, sales and expenses, investing activities, buying equipment, financing activities, loans, dividend. It helps business avoid running out of cash even if they're profitable. Limitations of financial accounting. Some things accounting does not do well. It ignores qualitative data like employee morale. It's based on historical cost, not market value. It can be manipulated if ethics are poor. That's why judgment and standards are so important. So let's have a recap. To recap, we defined financial accounting and its purpose, learned about assets, liabilities, equity, revenue, and expenses, understood how financial statements are created, explored ethics and limitations. Financial accounting helps business speak a universal language, and now you're starting to speak too. So this is the end of my lecture. Thank you for joining me today. I hope this introduction has helped you appreciate how structured, logical, and essential financial accounting is. If you have any questions, write it in the chat box. I'll reply to them. And I've just went through the basic of the introduction of financial accounting. I will go one by one in depth of them on my next lectures. Please tell me if you like, if you want anything regarding it. I hope you loved and please give a like and share of my lecture. Thank you so much.